All right, good afternoon, traders. Some of you, good afternoon again. Good to see everybody. Welcome out to the TradeSpoon Active Investor Workshop Series. We get to hang out every other Tuesday afternoon and have a chat about some type of strategy, some type of educational concept. Today's, I think, should be an interesting discussion. I want it to be a discussion. We're going to talk about when to roll, close, or take a loss. And obviously, close and take a loss may go hand in hand. But essentially, with option strategies, this is an important one because I actually come across this all the time when I'm coaching individual traders. They say, oh, so and so, right? Whatever subscription they might be, getting information from says, all you have to do is roll it. Just roll it. All you have to do is roll, right? And they make it seem like it's this magical strategy that you just sprinkle a little pixie dust and roll the trade, and all of a sudden it's like you're out of trouble and everything looks great again. And unfortunately, I hate to be the bearer of bad news, but that just doesn't work like that. Rolling is important to understand because that is something you hear people talk about a lot, and it's something that can get you into trouble as an options trader. So we'll talk about rolling, closing, just simply taking a loss. We're going to continue on in the vein of how we've been doing this recently, and that is I don't really have slides. I'm just going to talk. We're going to bring up trades. I might even have a couple in my platform that have gone a little against me where I could say, oh, what if I rolled this, what would that look like? I want it to be a discussion, so I want you to ask questions. If you've ever had a question about rolling, what does rolling even mean? What happens in the context of a roll? What do I get? What do I sacrifice? What do I have on my hands next? And then go from there. So thank you, Phil. I appreciate it. Hello to you again. Said that he can hear me fine, see me fine. So let's go ahead and get started. For those who don't know me, my name is Scott Beck. I am the head trading coach here at TradeSpoon. I deliver a good number of the trading rooms, Tuesday, Wednesday, Thursday afternoon, Friday morning. So I get to interact with subscribers on a regular basis. I like that. I have been, here's a little formal background, trading for over 20 years. I have been teaching, coaching, mentoring for, actually about 18 of those years. That's me. I do need to remind you very specifically, as always, that trading and options in particular can involve substantial risk and may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks, be willing to accept them in order to trade in these markets. TradeSpoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team of TradeSpoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, TradeSpoon founder, is also an investor and a consultant of AOS Inc., which does business as Trading Block and Money Block, and a FINRA and SIPC member broker-dealer firm. TradeSpoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay. It's quiet out there. I'm going to need everybody to step up their participation levels. and interact and say hello and ask some questions. So let's talk about, ready for some noise soon? Let's talk about roles. Let's talk about roles. Let's talk about closes. Let's talk about taking losses. So with a role, what am I doing with a role? The important thing that I want you to think about when you're rolling an option strategy is you are closing one and opening one. Always. What can I roll? I can roll things up, right? I can roll an entire spread or just a single option. I can roll it up. I can roll it down. I can roll it out, meaning by expiration. So if I need something that can go higher, I can roll it up. If I need something that can go lower, I can roll it down. If I need something with more time, I can roll it out. I can roll a single option or an entire spread. Because what am I doing? I'm closing a trade or a leg of a trade, and then I'm opening a new one. So there's a commission possibly involved, depending on your broker. So the broker gets paid. It's not like they're like, I don't know about the roll. Hey, if you pay them a commission, they'll roll it. You're closing and opening, so a market maker is getting paid. They'll be like, yeah, let's roll all day. Roll it, roll it, roll it. Now, when do people most often when do people most often want to roll? So a comment came in, Cecil said, hopefully you are speaking of adjusting spreads. Yeah, I mean, if you're adjusting a spread, closing something, opening something, then you're rolling it, right? Whatever you want to call it. When, why, and what's a good trigger point to adjust a bad credit spread? And that actually, Cecil, becomes the problem. When do we want to roll something? When it's gone bad, right? When it's gone bad. Psychologically, that's when we have the desire. We're like, oh, this trade's going against me. Maybe I can roll it. And there the roll is like this superhero. Dun 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 dun. Here comes the roll to save the day. The problem is it doesn't have like magic capabilities. If I roll, first of all, what happens? I take the loss that I'm up against. I take it. I have to. I take the loss and then I open a new trade. Higher, lower, further. So what does that new trade now have to do? The new trade has to have the potential to A, recover what has already been realized as a loss from the roll. Now, keep in mind, this is rolling a trade that's gone against you, right? I will talk about like good rolls or rolls that maybe have a little bit more potential, but like I said, 97% of the time when someone asks me about rolling something, guess what? It's already negative. It's already down. And they're like, hey, can I roll this? Sure. Sure, you can. You can do anything you want. It's your account. But should you? That's the better question. Now, when you talk about adjusting spreads does have other connotations besides a roll. So the way that some people will adjust a credit spread is by buying back the short leg in order to let the long leg run. That's not a roll. That is a flip. If I have a bull put spread, I do. I got one on Macy's. If I have a bull, don't I? That's not Macy's. That's Abbott Labs. We closed it for a profit. Here's a bull put spread. What do I want it to do? Go up. If it goes up, I make money over here. If it goes down, I lose money over here. There's my stop. I should be able to keep my loss down. Everything looks fine. What if all of a sudden, though, I thought, man, Macy's is going to go down? Now, what would make me think that? It would have to go through a whole reversal process. I personally don't go from bullish to bearish or bearish to bullish overnight. Has to go through a process for me. But what would the thought process be of adjusting this spread without rolling it? It would basically be to buy back the short. This 13 credit or 13 contract short for 61 cents. If I were to analyze a closing trade, if I were to buy that back, you'll notice it basically means these two cancel each other out and I'm left with a put. And that put makes money if the stock drops. Bull put spread makes money if the stock rises. Buy back the short, it's gone, and I have the other way. So that might be what you're thinking about. Now, the problem is this is a bull put spread. Now, remember the workshop title today is when to roll, when to close, when to take a loss. This would be B and C. I am going to close and take my loss there. Why? Well, because that loss is $170. Maybe more. When I figured it, it actually seemed more like $200. Risking around 200 to make what? Well, if it goes up to my target, or as long as it just goes above 28, I have the ability to make 650, upwards of over $1,000, depending on how long I might stay in the trade. So in this case, I have a favorable reward to risk ratio based on very specific parameters for where am I wrong, what is my risk, where am I right, and I have various levels of right. As long as it stays above 28, it's right. Time is on my side. That will go up. As the stock goes up, price is on my side. That will go up. If it goes against me, I have a finite amount of risk that I have contained at a certain level. So this is a very specific trade. I'm not looking to be like, oh yeah, everything looked great. Then it drops to 2680. And then at 2680, I think, you know what? Not only am I no longer bullish on Macy's, but now I'm bearish on it. Now I think it's going to drop. Oh, I mean, can you? Sure. Have I? Yes. Do I still? Not really. Okay, so there's an interesting stopping point. I've done it before and I don't do it now. What does that mean? Must mean it didn't work the way we think it's going to work on paper. Oh, all you got to do is reverse the trade. Then you reverse the trade. But remember what has to happen. The stock has to drop. If the stock drops, the short put's going to be losing money. So you're going to take a loss on that. Now what has to happen? Now the long put has to make enough money to offset the loss you've already taken and make its own money. But what happens if it just whipsaws the other way? And you just took a loss and now you have a long put and now the market whips the other way. Now we take double losses. Now this trade where I thought I'm gonna keep my loss around 200, I could lose 500 or 600 just like that. Right? A spread is a very specific type of animal. It's got a very specific delta that's not too fast. We built it for a reason. So the first thing I want you to think about is, are your plans for your trade strong enough that just because something starts to go against you, You're not going to be like, oh shit, maybe I should go the other way. Pardon my French, that slipped out. Oh shoot, a market went against me. I should probably just flip it and just flip it again and flip it. Man, think about how you could have flipped things around Thanksgiving. We were down, we were up, we were down again. Now we're up again. I don't want to get whipsawed by the market like that. So, how you built the spread in the first place matters. Here's what I would say to you about adjustments, whether it's closing a short to let the long run. Number one, that needs to be pre-planned. You need to pre-plan that. You need to know exactly when would you buy back. You would need to know exactly what type of a stop and management strategy you're going to put on what you left behind. And then maybe you could do it. Okay, so that's adjustments. Let's go back to rolls and closings and taking losses. If whatever you plan for at the start of the trade, that's what you should execute. Don't change horses midstream. That's my advice. If you start with a, hey, I have a line in the sand, and when it gets there, I'm going to take my loss because I've got actually a pretty favorable reward to risk ratio if I adhere to this, and then it drops, then you're like, you know what, maybe I should reverse it. Well, I didn't account for that when I position sized the trade. If I didn't account for it, then I have no frame of reference as to what the risk is or should be. Because in that situation, I'm just shooting from the hip. Okay, so let's stop for a second and talk about when is a good time to roll. I think that covered calls, calendar spreads, have great potential to roll for a profit. Where if I sell a covered call against a stock that I own and I'm getting closer to expiration, I can roll it to a further month where I say, hey, you know what? Rather than wait 2 more weeks to make the last 30 cents, I can buy it back for 30 and then sell 3 weeks out for $3. And that's a $2.70 credit on your roll. If you're rolling for a credit, you're doing something pretty good. It means you're taking a credit on something and opening another trade. Now, the new trade is going to have its own set of risk, rewards. It's going to have its own construct for right and wrong. And you're going to want to have that new trade pretty well determined prior to the roll, right? Don't make a roll, then be like, okay, now what? We should know now what. We should know what it's going to look like after we roll, after we roll it up or roll it down or roll it out for some more time. I'm running out of time. No matter what you're doing, if you roll it for a debit, you're losing. You're losing. So you better have a really, really good idea. Rolling is very similar to dollar cost averaging, if you think about it. Right? Do we dollar cost average as traders? We probably shouldn't. I definitely recommend not. Dollar cost averaging is what you're doing when you are investing in your 401k, retirement, stuff like that, right? You put a certain amount of money in every week, every month, every 2 weeks, and you buy. And when it's more expensive, you buy less. And when it's cheaper, you buy more. And over time, it averages. As a trader, the temptation is, oh, I bought this option for $2 and now it's dropped to 50 cents. So I can buy twice as many contracts and cut my cost basis almost in half. That sounds good, right? That's almost a roll to more contracts. It's not, but that's dollar cost averaging. What's the problem? You're taking good money and putting it at a bad trade. Because if that option goes worthless, buying twice as many of them at a cheaper price isn't a good thing, right? You're just throwing good money at a bad trade. So if you're rolling, you have to think, what is the objective? How am I going to accomplish that objective? So if your objective is to not lose money, Just realize the only way to not lose is to take a significant amount of additional risk. Whatever the new trade is, it now has its own risk in addition to the loss that was already taken on the trade that was rolled. I wish I could just, like participate when I'm watching and someone's like, oh, all you have to do is roll it. And I always tell people, look, if somebody ever says all you have to do is when they're describing a trading strategy, be skeptical. They might be right. But for the most part, the whole flippant, all you got to do is roll it and it's fine. Okay. And then what happens when that trade goes wrong? Do you just roll that one too? Do you have an infinite ability to roll trades? The answer is no. I don't know what they would say. I know the answer. It's no. Because every time you roll a trade, you're taking a new loss. If you roll and then roll and then roll, that third trade may not have the capacity in its maximum gain scenario to overcome the losses already taken. And believe me, when I work with individuals, I have seen that where I go into the analyze and I'm like, this shows that no matter what happens, you're underwater. No matter best case scenario, if this thing rallies, the best thing that can happen is you lose less. And if you ever find yourself in that scenario, then yeah, you missed a chance somewhere in there to close the trade and take the loss. There's a quote that I came across in my trading early on, resonated with me through the years. Very interesting quote that said, if I'm walking down the tracks and I see a train coming, I get off the tracks. I know you're thinking, man, that is profound. That is just good advice. If you're walking down the tracks and you see a train coming, get out of the way of the train. Think about that in trading, right? If I have a trade on and I'm thinking this looks great this way, and all of a sudden it's coming the other way, does it say jump off the tracks, turn, start sprinting, jump on the train? No, we're not talking about going the other way. I never meant to go that way. I'm going east. Why would I want to get out of the way of a westbound train and jump on it? Then I'm not going east. I'm going west. I just want to avoid because I was on the wrong side of it. So that's a very, very important piece. Well, some of these things we're talking about, you'll hear adjusting trades called salvaging. Let's salvage that spread. Oh, okay. What do I need to do to salvage it? You need to put more money at risk. Wait a second. Am I sure I want to put new money into this trade? Is it still even a good trade? So let's talk about when to close. Now, I have a trading rule that I'd like to share with you verbatim. This is a trading rule that has served me so well through the years. And you're going to hear it and at first you're going to be like, this is common sense. That's like a rule in basketball that says, put the ball in the hoop. It might seem like that at first glance, but as you think about it and you think about what goes into a rule like this and how it would help, the rule is simple. If the original reason for getting in a trade is no longer valid, get out. That's the rule. That's verbatim. It's in my trading plan. If the original reason for getting in a trade is no longer valid, get out. Now, what gives that rule meaning? First and foremost, specificity around the original trade. Why did I get into this trade? Because I'm bullish, because I think it's holding support and I think it's bouncing off of support. Well, that makes it easy. If I'm getting in the trade because I think it's at support and about to break out of support or bounce off of support, pardon, then I'm wrong if what? If it breaks support to the downside. That's support and resistance levels to me are critical components of any trade. I want to be at or near support and resistance levels, regardless, depending on which way I think it's going to go. So if it breaks support, I'm wrong and I get out. Now, what would cause us? What would cause us to do the opposite? So as we think about rolling, closing, taking losses, okay? There was a Nobel Prize winning study that was conducted in the early 1980s by a couple of social scientists, I don't know, psychologists, psychiatrists, whatever. Daniel Kahneman and Amos Tversky were their names. And they won a Nobel Prize for their study. What did their study conclude? What did this study talk about? Number one, talked about the fact that 80 to 85% of average investing public, you, me, everyone at some point, right, are inherently predisposed to cutting our winners short and letting our losers run. 80 to 85%. I remember when I first took answered the questions that were asked in this test. I was one of them early in my trading. I'm like, oh my God, that's eye-opening, right? It's astounding. 80 to 85% cut their winners short, let their losers run. Why? That's important. Why? Well, they came to another conclusion, and that is that the pain that you feel from losing a dollar, psychological, emotional, sometimes even physical pain, the pain you feel from losing a dollar is 3 times higher, on average at least, than the pleasure you gain from winning a dollar, 3 to 1. So when something hurts 3 times more for a very similar event, what does it lead to? Avoidance. I want to avoid that pain, which leads to loss aversion. And what are the emotions that we then end up feeling? The emotion we tend to start feeling when we're making money is fear. I'm afraid that the market's going to take my money from me. If I don't sell it today, it's going to take it from me. And now what do I get? Smaller gains. And when the stock goes against us, what do we feel? Now this is going to tie back in. What do we feel? Hope. Fear when we're making money, hope when we're losing. I hope it comes back. I hope I can salvage this trade. I hope I can dig my way out of this hole. I hope I don't have to take this loss because this loss hurts. Okay. Yeah. I appreciate that so much. I got a great comment says I was till very recently one of those 80 to 85. Could not accept the loss. Not anymore from Vlad and Scott Learning. Thank you, Osama. I appreciate that. I freely admit it. No, I definitely was one of them. Right? It's such an interesting insight into ourselves. But yeah, right. Uh, uh, um, when I work with individual traders, the first thing I say is we got to get control of your losses. That's think about it this way, and hopefully what you're gleaning from all of this is I want you to be very suspicious and skeptical about rolls, because what makes you want to roll? Hope. Why are you hoping? Because you're losing. And now we're doing the same thing we've done. To get what you've never got, you've got to do what you've never done. We've got to change the way we look at losses and gains, change the way that we interpret and then internalize and then take action. So, if you're rolling for a credit, I'm 100% on board with that. Roll for a credit all day, every day. If you're in that situation, if you're rolling for a debit, I want you to be suspicious and skeptical and careful. I want you to think about what's leading you to make that decision, to want to salvage a trade, to want to fix a trade, adjust a trade, roll a trade. I don't care what name you put on it. The thought process is the same. right? Why are we trying to do it? That motivation. Why are you doing this? That's important. It's important to understand, because then we have a better idea of what we're going to do to fix it. So how do I fix it? Well, the first thing is be specific. If you want to have the ability to roll the trade, then plan it from the very beginning. Say to yourself, I'm going to do this credit spread, but if it breaks below 27, I think it's going to fall apart. So at that point, I'm going to buy back the 28, let the 26 run. I'm going to put a tight stop on the 26. I'm going to try to figure out how much would I lose buying back the 28, and then how much more would I lose when I stop out if it whipsaws? How much more would I lose? And then say, okay, now let's position size at this number, and then that's it. Now you're like, okay, if it breaks to the downside, you're not going to stop out and take the loss. You're going to unwind it and let it run to the downside with a different plan in place. Great. You have a plan. It's proactive. You're going to stick to the plan and then adapt it as necessary. Cool. I'm on board. Right? Because if nothing else, you know that you've controlled your risk. If you want to dollar cost average and say, hey, you know what? I've done this. I've done this in the trading room where I'm like, you know what? I'm going to buy this much. If it drops and it gets cut in half, I'm gonna add, right? I'm gonna double up here, and then I'm gonna just let it ride. And if it comes back at that point, I'm good. If it doesn't, then I've lost no more than I was willing to, because when I first came into the trade, I figured out what that risk was going to be. If I'm going to roll it, I've got to be so very clear on how much the roll is going to cost me. What is the capacity for profit on the new trade? Does it have the ability to cover its own risk and the loss that I've already taken and still produce enough profit that I think, yeah, let's go ahead and do it. Here's what I want you to think about in terms of profitability, right? You want to be a more profitable trader. We all do. Great. What do we have to change? One of three things has to change. Number one, you've got to be right more often. And it's like, there's that appeal. Oh, I can be right on a trade that's gone wrong. I want to be right. Being right comes to some extent from a fear of being wrong, right? So I want to be right more often. Well, yeah, let's be honest, right? You don't get to just pick. I want to be right more. Okay. So you go from 50 to 60. Then what? Well, if I can be right from 50 to 60, I want to be right from 60 to 70. And if I can be right from 60 to 70, why not 70 to 80? And yeah, you realize that at some point that's just not going to happen, right? There's a fixed value of how often you're going to be right or wrong, and it's going to be very much dependent upon expectations for gain and loss. We don't live in a world where we just only focus on right or wrong. We have to think, well, how much do I make when I'm right and how much do I lose when I'm wrong? And that leads to the next step of how to be more profitable. So we have some ability to work on being right more often, right? Of course, we can always evaluate the patterns we use, our entry setups and our triggers, but yeah, what are we looking for here, right? I'm not trying to be right 80, 90% of the time. That's not how I'm going to be a successful trader. So what's the next key to more profitability? Make more money when you're right, i.e., let your winners run. Now, here's what's hard. When you think about letting winners run, letting winners run is not about rolling, right? Letting winners run is not about setting your targets higher, although that's what a lot of people have a tendency to do. They're like, oh, well, I'm just going to, if I, instead of setting my targets at 60, I'm going to set it at 65. Well, go back and look at your records. I guarantee you the problem isn't that you keep hitting 60 and getting out, and then the stock keeps going up to 65. That's not, right? Letting winners run means making sure that you're willing to sell some to book gains and then tighten stops to not let winning trades go back against you. Maybe if you're a trend trader, there's some times where you've gotten out. Maybe there's some times you've panicked when market conditions got a little dicey. But for the most part, managing winners is what you're trying to do, not set higher targets and just hope things just run better all of a sudden. But there's some very specific techniques and tactics involved with letting winners run. The last variable, and this is the one we have the most control over. You can't just wake up tomorrow and say, you know what, I'm going to be right more often today. You can work on it, test some things, work on signals, etc. You can't wake up tomorrow and say, you know what, I'm going to make more money when I'm right. Again, you can work on that. You can work on how you set targets, how you manage winning trades, how you scale, how you do those things. But you don't just wake up and make a decision. You can. You absolutely can wake up tomorrow and say, I'm gonna cut my losses short better. I am going to close a losing trade when it crosses my line in the sand. I'm not gonna be like, but what if tomorrow it comes back? What if it does? If it crosses your line in the sand, stick to the plan. Take your loss. In order to cross your line in the sand, what do you have to do? You got to draw a line in the sand. I have to know where I'm wrong. If you don't know where you're wrong on a trade, you shouldn't take that trade. That's my opinion. If you don't know where you're wrong on a trade, you shouldn't take the trade, because if you don't know where you're wrong, how are you deciding how much to trade, how much to buy or sell? How are you position sizing? Because if you don't know where you're wrong, then you don't know what's at risk. And if you don't know what's at risk, you don't know what to position size in order to say, here's how much I should buy. It's all tied together. Everything we do is tied into this great trading plan that we're working on and trying to build. So where do roles fit in? Either they're pre-planned or we don't do them. Period, for me. If you've pre-planned a roll that says, if it does this, I'm going to roll this way. I'm going to roll up, I'm going to roll down, I'm going to roll out. Okay. You can roll on price action, crossing a certain line. You could roll on time, crossing a certain line. You can roll off of Greeks. If the delta gets to here, do this, right? Certainly, I worked with the guys who built the Thinkorswim platform. They would roll. All right. And then they had a specific set of rules and methodology, and obviously tried to quantify their risk when doing so. If you're rolling for a debit, be extremely cautious and skeptical about what you're doing and what it's going to lead to. Understand, what is the loss you're realizing when you roll? What is the potential of the next trade if you roll? What is the exit strategy for the next trade if you roll? If those are in place, if they were pre-considered, great, do it. If you're just reacting, so again, I don't even remember what it was. I had a mistake that I made. It's probably 17 years ago now, 8, maybe 16. And I was so frustrated by it. I took a piece of paper and I wrote, "Why are you doing this?" to myself. And I taped it on the wall next to my monitor. What an amazing, I've actually had people that I've assigned to do that. And I've probably got a few dozen pictures of people's trading desks with their handwritten sign. Why are you doing this? Why are you rolling? Start with your psychological motivation. Is it because you don't like taking losses? You're not willing to take a loss? You recognize things are going wrong, but you don't want to take the loss? If that's why you're doing it, it's wrong. If you're doing it because you're following your plan, it's right. Why are you doing this? It's that simple. If you're rolling for a credit, always better than rolling for a debit. That's just extending a trade that's going the right way. Awesome. Love it. Do it. Rolling for gains, yes. Rolling for losses, be careful. If it's pre-planned, okay. If you're doing it because you're avoiding a loss, if you're doing it because you don't want to be wrong, If you're doing it because it might come back tomorrow and that hope is kicking in, it's wrong. Wrong, wrong, wrong. And you are struggling to take losses if that's the case. I promise you, you are. If you were to go through and do some record keeping and start looking at average loss size, average win size, winning percentage, losing percentage, if you would go through and look at that, you would see exactly what I mean, and you would realize, oh, I got to get these under control. For my winners to be able to do more, I have to control the losses first. That is the first skill for any trader to develop, period. It's a decision. It's a mindset. It's a lifestyle. So I was curious where this presentation would go. And it definitely took a psychological turn. I'm not surprised that it did. A lot of these things do. A lot of strategies should be evaluated from a motivation standpoint. Why are you doing this? I actually thought about putting that on a coffee mug. Trading tools, right? Anyways, your thoughts on A, closing out an options position with a gain of 60% versus a trail stop. And then where do you put the trail stop? Okay, so 60%, 60 to 70 for me is where it's kind of getting to that level where I would maybe start to scale out. A third, a half, something where you book the gain and then you can definitely, it's so much easier to let things run when you've eased the size of what's running and already locked some gains in. So early in my trading, when I was a younger man, I'd be like, oh, I'm not going to sell half. I want the whole thing. I want the whole thing to get to my target so I can make all of my money, right? Of course I do. And then I realized, well, I don't get to my target enough. So what do? So I start to make it easier to get to the target by selling along the way. Then if something falls apart, right? So yeah, 60%, definitely starting to think about it. 80%, definitely taking it. And when you get past that 80% mark, you start getting to a point where trades might not make sense from an ongoing reward to risk standpoint. If I start a trade, I'm risking 250 to make, let's say 600, and I've made 500 of it. 5 of 6, I'm about 80%. You got to ask yourself, you've got $100 left to make. How much are you willing to risk? Because if I have to make 200, if I have to risk 200 to make the last 100, I'm done. I'm like, yeah, this trade's over. I'm going to take my 500. I'm not going to risk 2 to make the last 1. That doesn't make sense. That violates the thought process. And so I'm going to not do that. My thoughts on where to place the stop. You guys know I love Heiken Ashi candles for moving stops. It's a great momentum trade. For a swing trade, Heiken Ashi is a great way to go. But actually, it's not bad for a position trade if you're doing longer term trades, 6 to 8 weeks off of weekly charts. Heiken Ashi are pretty good. So, yeah, that's worth looking at for sure. Okay. So we've got a few minutes left here. I'm going to just open it up for questions. Hopefully the rules, according to Scott, are coming into focus. Just be skeptical and cautious. If you don't have the tools to run the numbers, don't do it. If you have the tools, run the numbers. If you're comfortable with it, do it. Be aware of the psychology behind what's motivating you to get there. Do that all the time, but especially if there's a role. If there's a role for a debit, yeah, you better have a really good reason. Roll for a credit, hell yes, do it. Throw it down. I have no problem with that. You just rolled for a gain. Everything about that trade is better now at that point. So think about, what puts us in a position where we're trying to roll. Of course, we want to roll. Hold on. One other thing. The more you're losing, the harder it is to roll. Of course, right? It's a slippery slope. So if you can roll early in a loss, you're going to be a lot better off. But if you're like, this trade's 80% against me, how do I dig out of this? You don't. You don't. You can't. I wish I could tell you better news than that. And if someone's telling you that they'll show you how, be careful how much you offer to pay them for it, because it's not going to work. You can't. Whatever you do next has to be able to pay off that huge loss that you already have, plus maintain its own reward to risk ratio. That's hard enough. You already saw how hard the initial trade was. What makes you think the next trade's going to be better? Right? So there it is. That is rolling versus closing versus taking losses. Whatever you're going to do, have that knowledge in place before you place the original trade. Understand to the T, to the decimal, what your risk will be that you realized, your loss that you realized, what the new risk will be, what the new reward to be, and if based on what you see on the chart, those numbers make sense. Please give some guideline parameters on the amount of credit to seek for $2 wide, $5 wide, $10 wide, ideal time for expiration. You see, that's the hardest thing, Cecil, is it's very much dependent on implied volatility. What you get in a 30 versus a 23 versus a 15 VIX. They're all very different. There is no standard rule of thumb. It's all going to be very much dependent upon implied volatility. So I think what you'll find is that if you are, ideal time for expiration for me for a credit spread's about 6 weeks. In fact, today we looked at a 2-week versus 6-week, and the credits weren't that far apart, but the reward to risk ratios were. Why? Because it's a lot harder to control a spread over 2 weeks than it is longer term. So when I do credit spreads, I'm trying to find balance between time decay. Of course, I want it working for me, and the ability to control the trade. The shorter you go, the more time decays in your favor. The longer you go, the more you have the ability to control your risk. So it's a sliding scale, like most decisions in trading, where your job is to understand your pawn. Are you more willing to sacrifice the ability to control the risk to get faster time decay? Go shorter term. Are you more willing to sacrifice faster time decay for an ability to control the risk? Go longer term. Everybody's answer is different. It's very difficult to say, here's the rule of thumb. Depends. Unfortunately, depends is the answer to those questions a lot of the times. Any other questions on the concept of rolling, taking losses, adjusting, closing, salvaging? For a little while, we had an affectionate nickname for salvaging or adjusting a spread. We called it dumpster diving, if that gives you any idea. Looks good on paper, a lot harder to accomplish live trading. So, okay, well, do I use delta as a trigger point? I don't. Delta as a trigger point would be more of a probability measure. So if you entered the trade based on some probability factor, then you might exit or adjust the trade based on a probability factor. I enter trades based on price action factors. When you ask, why are you doing this to take a trade? Most of the time, my answer is going to be technical because of what I see in the trend, in what I see in support and resistance levels, candlesticks, volume, whatever indicators, the trade spoon model, right? If technicals are what get me in, technicals are what I will use to adjust or adapt the trade, along with obviously reward and risk modeling, which I do before I get into the trade as well. So I don't personally use delta, but I have worked with traders and known guys who do. So I'm not saying it's not valid. It's not valid for me because that wasn't the reason why I got into the trade. Whatever reasons you used to get into the trade are going to be your best answers that you use for getting out and or making adjustments. Awesome. Well, that was fun today. I hope you enjoyed it. I hope I gave you some things to think about. I hope you will take some time to consider your thought process around taking losses, around cutting losses short, letting winners run, around the psychology behind that. I will be back in 2 weeks. So next week I'll be in Florida, Disney World. Should be fun. The week after, I'll be back home ready to meet with you wonderful people again, and we will have another session on something fantastic. I don't know what. I like to keep it a surprise. I usually look at it about an hour before we start, and then I'm like, "Ooh, this sounds like fun." I'm gonna be ready to go. So, anyways, thank you, Phil. I appreciate that. Thank you, everybody, for your time, for your attention. Um, and I will see you in 2 weeks. Unless you're on the inside, then I'll see you tomorrow. And if you're not on the inside, go think about it. Anyone who is here to just consider TradeSpoon, we do awesome stuff. Vlad is an awesome trader. I can hold my own. So if you've ever thought about, hey, should I do it? Remember, you get 30 days risk-free. So if you sign up and then you're like, you know what, you guys said it would be great and it wasn't, you can always get your money back. Thomas, unsolicited, just said, best learning investment I made. Thank you, Thomas. I hope I, in some small way, contributed to that. Anyways, we do have a great community too, man. We get really good trading ideas and exchanges in our trading rooms too. So anyways, and Osama seconds Thomas. So unsolicited. The Lord knows I'm not afraid to solicit compliments, but this was unsolicited. Thank you guys. I appreciate it. I had a lot of fun. Enjoy the rest of your day. I hope I do see you tomorrow. If not, I'll see you in a couple of weeks. As always, happy trading.